For the past 3 years, federal student loan borrowers had their loans paused, and that is about to end anywhere between now and August of 2023. If you're like me, one of the 43 million people that has a federal student loan, there's some important info that you need to know before these payments start up again. A few years ago, due to obvious reasons, the whole world got turned upside down. Under President Trump, federal student loans interest and loan payments were paused originally for 60 full days due to the CARES Act. The act was signed into law March 27, 2020, and applied retroactively on March 13, 2020. These pauses continued as the situation developed and eventually were paused all the way through January 31st, 2021. As of January 2021, President Biden is now in office. His administration has since brought forward the Biden-Harris Student Debt Relief Plan. Part of that plan includes forgiveness of student loans for eligible borrowers, up to $20,000 in some cases. Naturally, there was opposition to this plan and a lawsuit came about questioning the legality of the whole thing. This, of course, introduced even more uncertainty when it came to student loans, but the pause was extended for the entire duration of 2022. As of making this video in 2023, that lawsuit is still underway, but the information out there currently is very clear. As of now, there will not be another extension of student loan pauses despite the lawsuit. The pause will end 60 days after the Supreme Court makes a decision on the case. If no decision has been made by June 30th, 2023, payments will resume 60 days after that. In either case, the bill is coming due with a firm line in the sand. By the end of August 2023, federal student loan borrowers will start accruing interest again and payments will be due. So much has happened in the past 3 years, from the stock market setting new all-time highs, the rise of meme stocks and dog-themed cryptocurrencies, to record inflation and the collapse of multiple banks. A lot has changed in the world of student loans as well, and that of course affects every borrower and our wallets. Before we get to the 5 things that every student loan borrower needs to know, remember, I'm not a financial or a loan advisor. This video should be taken for what it is, a starting point for you to get familiar about what you need to know about student loans on pausing. Remember, when it comes to your own situation, generally speaking, there are some best practices, like figuring out what kinds of student loans you have and how much you owe on them, and then figuring out the best way to pay them off with all your options available. Now, sorting through all that information can get very confusing, but don't worry, there is help available to you and it is completely free. Reach out to the Federal Student Aid Student Loan Support Center and your individual loan servicer. They offer free counseling on your loans, and if anyone is trying to get you to pay for help with your student loans, be very careful. Scammers are just waiting to take advantage of you trying to do the right thing, paying your loans off, and will happily take your money and advantage of you. With that being said, let's get to the 5 things every student loan borrower needs to know. Number 1 is check to see who your loan servicer is. Before 2020, my loan servicer was Navient. Since then, Navient no longer serves federal student loans. My loans were pushed to a company called AidVantage. I didn't actually have to do anything while this was going on. The two groups seemed to work it out on their own, and eventually I was able to log into my new account and everything was fine. But I no longer have access to the Navient account. So before you're trying to log into an account that doesn't exist, even though you're 100% sure your password is correct, double check to see if your loan servicer has changed. Number 2 is update your contact info. In 2020, I lived in a completely different state. I know it's basic, but 3 years is a very long time, especially for a student loan borrower. You're probably switching jobs, cities, or maybe even countries. It's been a long while since we had to think about these payments, and it's easy to forget to update your basic info, and now is a great time to do that. Number 3 is review your auto debit payment information. If you were making automatic payments before March of 2020, you're going to want to make sure you set that up again with your new loan provider if that applies to you. And if your loan provider is the same, you're going to want to confirm that you still want your loans to auto draft every month. Now, according to the official documentation, it should auto draft automatically if you had it set up for that and your loan service provider didn't change, but I would double check just to be sure because this is a complicated process on the back end. Number 4 is to figure out if you're going to be using public service loan forgiveness. For those of you that don't know, the PSLF program forgives the remaining balance on your direct loans after you've made 120 qualifying monthly payments under a qualifying repayment plan while working full-time for a qualifying employer. This program is full of nuances, subject to change, and complex enough to have an entire video dedicated on it. What you need to know about it now is that not all of the repayment options count towards PSLF payments. So keep that in mind when you're planning your loan repayment strategy. And number 5 is consider all repayment options. Knowing your options gives you flexibility. This can mean the difference between you actually paying your monthly bill or not. According to the Federal Student Loan website, there are 8 official repayment options. First up is the standard repayment plan, where all borrowers are eligible and payments are in fixed amount over 10 years, or within 10 to 30 years if you consolidated your loans. With this plan, you'll usually pay less over time compared to other payment plans, but be aware this payment plan will probably have the highest monthly payments, and payments under this plan do not qualify for public service loan forgiveness. Generally speaking, the 10-year standard plan is the fastest and cheapest student loan repayment option. Second is the graduated repayment plan. All borrowers are eligible, and in this payment option, your payments are lower at first and then gradually increase as time goes on, usually every 2 years. Under this option, your loans are paid off in 10 years, or 10 to 30 if you consolidate. Because you pay less in the beginning, you'll pay more over time compared to the standard 10-year repayment plan, and these payments do not qualify for public service loan forgiveness. Our third option is the extended repayment plan. If you're a direct loan borrower, you must have more than $30,000 in outstanding loans in order to be eligible for this. In this option, payments are fixed, just like in the 10-year option, but instead of paying your loans off in 10 years, you'll pay these loans off in 25 years. So your monthly payments will be lower than the standard plan and the graduated repayment plan, but you'll pay more over time in comparison to the 10-year plan. And under this option, payments do not qualify for public service loan forgiveness. Our fourth option is the revised pay-as-you-earn plan. For this plan, and others we'll mention later, you'll need to know what discretionary income is. Discretionary income is what a household or individual has to invest, save, or spend after necessities are paid. Examples of necessities include the cost of housing, food, clothing, utilities, and transportation. Any direct loan borrower may choose this as an option. Under this plan, your monthly payments will be 10% of your discretionary income. Payments are recalculated each year and are based on your updated income and family size. And even if your income and family size hasn't changed, you still need to update your forms every year. If you're married, both you and your spouse's income and debt are factored in, whether your taxes are filed jointly or separately, and there are some exceptions to this. Under this plan, any outstanding balance on your loans will be forgiven after 20 years of payments. If all of your loans are taken out for undergraduate studies, if any of your loans are taken out for graduate or professional studies, they'll be forgiven after 25 years. Under this plan, your monthly payments will be lower than your standard 10-year plan and the graduated repayment plan. You'll also pay more over time, and these payments do not qualify for public service loan forgiveness. And remember that any amount that's forgiven under this option will actually be counted as income, and you'll be taxed on that amount. So make sure you have enough cash on hand. Our fifth option is the pay-as-you-earn repayment plan. In order to qualify for this option, you must be a new borrower on or after October 1st, 2007, and must have received a disbursement of a direct loan on or after October 1st, 2011. Your monthly payments will be 10% of your discretionary income, but never more than you would have paid under the standard 10-year repayment plan. Payments are recalculated each year based on your size of your family and your income, and you must update your income and your family changes every year, even if there were no changes. For this plan specifically, you have to have a high debt relative to your income. Your monthly payment will never be more than the 10-year standard plan amount. You'll usually pay more over time than under the 10-year standard plan. This plan is a good option for those seeking public service loan forgiveness, but remember, you will most likely pay income tax on any amount that is forgiven. Our sixth option is the income-based repayment plan. In order to qualify, you have to have a high debt to income ratio. Your monthly payments will either be 10 or 15% of your discretionary income. This would depend on when you first received your loans, but they would never be more than what you would be paying under the 10-year standard plan. Payments are recalculated each year based on your income and your family size, and you must update that every year. If you're married, your spouse's income and debts will be factored in as well, but only if you file a joint tax return. Any outstanding balance on your loans after 20 to 25 years, depending on when you received your loans, will be forgiven. But remember, that will be counted as income and you'll pay taxes on that. Our seventh option is the income contingent repayment plan. Any direct loan borrower with an eligible loan type can choose this plan. Under this plan, your monthly payment will be the lesser of 20% of your discretionary income, or the amount you would pay on a repayment plan with a fixed payment over 12 years, adjusted according to your income. Payments are recalculated each year based on your family size, your income, and the total amount of your direct loans. And just like other plans on this list, you have to update your income and family size every year. And if you're married, your spouse's income and loan debt will be considered only if you file a joint tax return or you choose to repay your direct loans jointly with your spouse. Any outstanding balance will be forgiven after 25 years of payments and will likely be treated as income, which means you'll be taxed on it as well. With this plan, you'll probably pay more over time compared to the standard 10-year plan, but payments under this plan do qualify for public service loan forgiveness. Our eighth option is the income-sensitive repayment plan. This option is available only for FFEL program loans, which are not eligible for public service loan forgiveness. Under this plan, your monthly payment is based on your annual income, but your loan will be paid in full within 15 years. You'll pay more over time compared to the standard 10-year plan, and the formula for determining your monthly payment can actually vary from lender to lender. Now, I want to be clear, there's no one best repayment option because every borrower has different circumstances. One huge element that I want to emphasize is that not every borrower is eligible for every loan repayment option. It depends on what kind of loans you have. Since everyone's situation ranges so widely, it's hard to give solid advice. But I don't think you can go wrong by balancing the affordability of the loan while also trying to minimize long-term interest accrual. And of course, the best place to reach out for help is your loan service provider or directly from the federal government. Borrowers should also be aware that loan forgiveness is not free money. You'll most likely end up paying income tax on any amount of loans that are forgiven. So before we get in trouble with the IRS, just make sure that you have enough cash on hand for that big tax bill. And of course, public service loan forgiveness is not guaranteed. It's a government program that can be changed. And not every repayment options payments even qualify for the program to begin with. Okay, let's say you went through all 8 of these repayment options and none of them were affordable for you. Most official sites regarding this topic would tell you to work directly with your loan servicer and the federal government. You want to see if you qualify for deferment or forbearance. Both allow you to temporarily postpone or reduce your federal student loan payments. The main difference is that if you're in deferment, no interest will accrue to your loan balance. If you're in forbearance, interest will accrue on your loan balance, but both options can be helpful in the right circumstances. Hopefully you're not in this position, but if you are, working directly with your loan servicer is the best place to start. I know student loans aren't the most exciting topic. There's a lot of stress and uncertainty, and of course they're very politically charged, but I do appreciate you watching this video all the way to the end. If you found value in it, click that like button, subscribe for more money, finance, and crypto content, and I'll see you in the next video. Take care.